the challenge for the banker and the credit team are how to assess and analyze something which is new, a new sector, a new asset class. What risks are acceptable? How can we structure around them? That's particularly relevant in the energy space at the moment, which is obviously kind of quite dynamic, and we expect new things to come through. Financing a subsidized renewables transaction or a CFD-backed transaction, everyone knows what the risks are and what the parameters are, so everyone can focus in quite quickly on the areas of concern and risk. When something new is presented, then it feels very different because everyone needs to go back to basics. What are the risks? How do we structure around them? And both parties need to come with an open mind and work constructively.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm John Feddersen, co-founder and chief executive of Aurora. And the focus of today's show is the evolving role of project and infrastructure finance in the energy transition. And I have perhaps the ideal guest to cover this today from a European perspective. My guest leads one of Europe's largest and most influential energy infrastructure and project finance teams. He's a veteran of over 2 decades in Europe's project finance industry, having spent his banking career entirely with Royal Bank of Scotland, NatWest. My guest on the show today is Bruce Riley, Managing Director for Infrastructure and Project Finance at NatWest. Welcome, Bruce.
Morning, John. Thank you for that welcome.
And great to have you here. I'd like to start with your journey. And so, as I say, you've unusually, I think, probably spent almost 2.5 decades at the same organization and in the same industry, to a time before renewables finance was even a thing. How has project finance as a field changed over those 2.5 decades?
Well, I think, I guess the most obvious changes as I look back are really the changes in the pipeline of transactions that we see. There's been a very significant change. You go back kind of 15 years ago and things would have been dominated by PFI, PPP, which are generally, long dated transactions and with kind of relatively benign risk profiles. But, when you look at the pipeline now, it's clearly predominantly in the energy space and renewables. I guess we've seen quite a bit in broadband fiber and that space developing over the last 3 years. But I think the risk profile is different. We generally see shorter tenors, a lot of mini perm structures, and I think more risk than perhaps we generally saw kind of 15 years ago. And I think, as we look forward to how that pipeline is going to evolve further, I think it's probably, more of the same, and we have some challenges coming up. I guess now we have the challenge of unsubsidized renewables and dealing with, maybe more merchant power risk than we have done in the past. But, we're going to see the development of a hydrogen market, carbon capture projects, and I think we are seeing a demand perhaps for more flexibility in our financing from some of the consolidators in the renewable space that want to build portfolios and need a bit more flexibility. So I think it's an evolving evolving journey with respect to the risk profiles that we need to look at.
And as a follow-up, you talk about the evolving risk profile, the evolving technology. Do you think that changes the natural skill set of a project finance banker? So I had Harry Boyd Carpenter on the show, who's at the EBRD. He's an ex-lawyer who's become a project finance banker. And it seems like there's a lot of lawyers in project finance, or at least there were pre-2008. I think Gary and your team is another good example of a great lawyer that became a project finance banker. is it still the lawyers and that skill set that's useful in a world where it's less about long-term contracts and guaranteed revenues and dotting I's and crossing T's and all of that sort of stuff, and it's more about merchant risk and structuring and assessing risk and cash sweeps or whatever it is? Do you think the skill set's changed over that period of time?
No, I think we've always looked for a mix of skill sets across the team, the legal aspects are a big part of project financing, kind of in the past and today, and those skill sets are very useful. But also, the numerical aspect, financial modeling is a massive part of project finance. We often recruit kind of people with a financial background, from accountancy firms or from other kind of financial backgrounds. So I think as we look at the team, we like to have a mix of skill sets.
Mm-hmm. Very good. And just one other small digression on that. Interest rates have declined a lot over the last 2 decades. Do you think that has that played a role in your story of a sort of move towards merchant risk, or how have you seen declining interest rates impact your industry? And perhaps the answer is not at all. And equity returns of expected cost of capital has declined across both equity and debt. But how have you seen the biggest impact of the change in the cost of debt over that period of time?
Yeah, I mean, I think it clearly it must make a lot of projects that perhaps wouldn't have been economic given the overall reduction in cost of capital. I guess the pipeline is what it is, and the pipeline evolves according to what society needs and direction of government policy, etc. So I don't think kind of rates have really impacted us other than perhaps a greater pipeline than would have otherwise been the case.
Yeah, interesting. So were interest rates higher? Obviously, it's a counterfactual. We'll never know the answer to, but were interest rates higher? Arguably, government would be needing to play a bigger role in decarbonisation than the private sector. Interesting. Excellent. So I'd like to talk a bit about NatWest specifically. And one of the things that's very interesting about NatWest is the extent to which you are you've embraced renewables, you've embraced the finance of assets in the energy transition. How do you see, this is a broad question, but how do you see the relevance of renewables, low carbon finance in your loan book strategically? Why is it so relevant to NatWest?
Yeah, so I think kind of first and foremost, we've had a very good track record in renewables over the last 10 years. I mean, I think if you look back, a decade ago, I think people were probably asking, offshore wind, will it work? Have they got the wind forecasts right? Is it bankable? But you look back now and I think it's performed extremely well. And
it's a good bet to take. Betting on decarbonisation was a good idea. Yeah,
absolutely. So it's done what it said it would do, and it's performed very well from a credit perspective. The only issue we've had is actually kind of regulatory risk, particularly in some of the southern European countries, post the financial crisis, where there were some retrospective changes in subsidies and tariffs, and but really that's the only place where we have suffered losses. I mean, other than that, it's performed very well, and it's performed very well through the COVID crisis as well. I mean, there were concerns about construction programs or supply chains. But we've only had very minor problems on the projects and on the book. Everything has come through and performed well. So with that background, and also that the bank now moving towards or having adopted a climate purpose, furthering the energy transition and transition to a low carbon economy is at the forefront of what the bank wants to do, and obviously renewables is a big part of that. So those things combined mean that this is a place where the bank wants to deploy more capital and direct the expertise of its people to do more. And I think also as we look at kind of in a post-COVID world, as the bank looks to maybe redefine where it puts its capital and what sectors it wants to focus on, then renewables is really at the top of the list.
Mm-hmm. Interesting. It's just to pick up on one thing you mentioned there around. It's heartening, I suppose, that the big risk that you've seen over the last decade has been regulatory rather than technological. When the private sector, or when the industry says it's going to do something that's new, at least over the last decade, it's worked reasonably well. Hopefully, bodes well for hydrogen and some of the other technologies that are in the pipeline. On the regulatory risk, so how does it? So you got burned a bit, just like everyone else in Spain, in particular, going back to those, the wind subsidies in the end of the 2000s, I suppose. How does and now Spain's really holding up. Aurora's Ana Barrias, who leads our IBM practice, run off her feet at the moment with capital for solar, wind refinancing, all of those sorts of things. And now we've got the Spanish government in the last few months say, hang on, we're not very happy about the level of the European carbon price. We're going to try and claw back some of that value from the power market as well. Now we'll see what happens. And I don't think we think it's going to happen. But how does a conversation, you're sitting there, huge amounts of capital being deployed, lots of banks very active there, Spanish banks being aggressive in terms of merchant risk and pricing and things like that. How does an internal conversation at NatWest go when it comes to, say, Spain now? Are memories short? Do you approach it from first principles and say, well, this is the structures now? Or do you sort of say, look, fool me once, shame on you, fool me twice, shame on me, kind of thing? I know it's a big question, but how does that sort of conversation go? Because the whole sort of how important is it to be a credible government, I think, is really important in the cost of the energy transition. You see it in the spreads in Germany, where the German government is very loath to change rules, even when they're demonstrably distortionary and don't make economic sense. They sort of say, we said we were going to do it, so we do it. How do you approach that within the bank with your credit team, those sorts of things?
Yeah, so I would say memories are very long, and there is institutional memory, and I think one of the strengths of our team is that we've got credit people who've been around a long time and are very experienced. So it is a very significant concern, and certainly if we think a project has significant exposure to regulatory risk, or there's a significant subsidy or supporting a transaction, then we probably won't do it. I think it's also a matter of I guess client selection. We're more likely to look at a transaction with a major player that has significant resources and a lot of experience, is a strategic investor in that space, perhaps one that's also pan-European and is a consolidator of assets, building diversified portfolios. Those are the ones that we would be more inclined to look at. Certainly smaller developers, single assets would be a lot more challenging for us to look at, I think.
Mm-hmm. Interesting. So just another question kind of along these lines is, NatWest has been for I suppose for a long time been a supporter of unsubsidized asset. It goes back to, I suppose fossil fuel lending 20 years ago, CCGTs, and these are merchant assets. So you've got a long history of sort of unsubsidized, backing unsubsidized assets. Lightsource BP, I think, was a big one recently. Do you approach these differently to the way you would approach a fully contracted or a largely fully contracted asset, or are the principles the same as you see it?
Yeah, I think the underlying principles are the same, and obviously, we've been doing, part merchant deals for a long time with all the ROC transactions that we've supported over the years. I think we do see and recognise that. There's quite a variety of profiles of transactions coming through now in terms of unsubsidized deals, and often they can look very, very different. So we have spent a significant amount of time with our credit colleagues over the last year, developing a framework as to how we would look at unsubsidized deals. So, to ensure that we can be kind of clear and transparent in terms of what we need. And that's looking at parameters, such as counterparty strength, the break-even, power prices, how much balloon is outstanding at the end of a PPA period. So, we have a variety of parameters that we look at, and levers and structural features that we would look at, and so I think we are now, we can be fairly clear with people when they come to us with a transaction, what works for us and what doesn't.
Do you think there's in terms of like risk analysis approaches, just to digress briefly on this one, do you see a consistency across the industry? Or when you come into a consortium to finance, be it an offshore or an offshore wind farm, do you get the sense that when you talk to other banks in a consortium, you're speaking the same language around risk nowadays? Or do you see a great divergence of approaches in terms of the way people evaluate risks in merchant projects across the industry?
No, I think we see a consistency of approach. I mean, the concepts are the same. So people may have slightly different risk appetite or approach things differently, particularly if it's their local market and they have very strong relationships. But generally, I think the overall approach conceptually is the same.
Mm-hmm. Great. And I had a final kind of NatWest specific question, and it goes to this trend within corporates of making long-term climate commitments, the BPs and the Shells and net zero and these types of things at some point in the distant future. NatWest has made a bunch of commitments around renewables use, electric vehicles, those types of things. Do you see that type of commitment from the very top of the organization, board level commitments, filtering through into decision making throughout the bank? How does that sort of, it's a sort of sign of intent. We're going net zero. This is what we stand for as an organization. This is what we tolerate. This is what we don't tolerate. This is what we encourage. Do you see those sorts of big proclamations without the details necessarily filtering through to all sorts of parts of the bank, like project finance and others?
Yes, I mean, absolutely. I mean, so last year the bank announced climate as one of its purposes, and so climate is now central to everything we do and all the decision making. So absolutely, it has a big impact. In terms of credit decisions and business selection and how we want what we want in our portfolios and which customers we support. And one of the key commitments that the bank made last year was to reduce its financed emissions by 50% by 2030. So that is was a significant commitment, and a lot of work is going on to work out what does that mean and how do we implement that? I think that to an extent there is a kind of a lending choice there, and other high carbon sectors that we would exit or do less in, but that's not really the whole story. That's not going to get us there. It's also about our customers need to essentially reduce their emissions and decarbonize. So it's how do we help our customers to do that, and so there's a lot of work going on to think about that and how we do that, particularly in sectors such as property and housing and agriculture, which are kind of high carbon sectors.
Yeah, and obviously a huge opportunity from a finance perspective. Some of the solutions that government and experts tell us will be required are hugely capital intensive over the long run. To the one other aspect you didn't mention, I suppose you talked about one of your official purposes being climate. Do you find these sorts of things help with recruiting as you look at the very youngest entrants into the business? There's a sort of, going back through history, I think finance had a bit of a bad name, 2008, 2009. 2010, it was sort of, you guys caused the financial crisis. Obviously, the finance industry is a broad church, but I think in a sense there was a bit of this stigma. Do you see like NatWest as a place where a young person can come and make an impact in the energy transition? And is that what people think about when they join your team and join the bank?
Yes, I think it is. I guess not just young people, but across the organisation. I think people are really enthused about the climate purpose and the effort going on to deliver on that. And so yes, I think it does have a incredibly motivating impact on people. But yes, it's certainly young people looking to join the team. The fact that the role that we're playing in financing renewables is always part of their motivation in joining the team.
Yeah. Okay. Yeah, and a vitally important part of the industry. Flip side of this, and I'd like to zoom out from NatWest and talk about the industry. And talk about coal finance. So a lot of banks in the UK, still, I suppose, at least indirectly finance coal assets. But there's been a huge pullback. You see examples of this in my own country. AGL, who's the biggest polluter, is sort of struggling to finance, or saying it's struggling to some extent to finance some of its coal assets. Do you see this pullback by kind of Western commercial banks having an impact on the viability of coal assets, or is this a sort of squeeze the balloon type thing where there's plenty of banks in the world, most of them aren't in Europe, most of them probably aren't in Europe or the US, and there's plenty of debt available if you want it as a coal asset. How do you see that playing out?
Yeah, it's a difficult question to answer. Certainly from our perspective, we haven't financed coal projects for a number of years now, and we've certainly been looking at our policies towards coal, and last year we announced that we would stop lending to companies that have more than 50% of their business in or derived from coal, unless they have a credible transition plan that's aligned to the Paris Agreement. And we've also set out a deadline of being out of coal entirely by 2030. So, it's certainly kind of central to what we're doing. And I haven't kind of followed all other banks in terms of their policies towards coal, but I think this is the direction of travel for certainly all of the European banks. And banks are under a lot of pressure from shareholder action groups and NGOs with respect to policy towards coal. So the direction of travel is only kind of one way. So certainly, as you say, I think it will be increasingly hard to secure financing for coal from some of the European banks. I don't have enough visibility across kind of Asian banks to understand what their position is, but you would have thought that certainly this will have this should have an impact over time in terms of ability to finance coal assets.
Interesting. It's one of those ones where anecdotally coal generators are saying we're really struggling here to finance our assets all over the place. Not carbon prices, not with. First of all, there's a whole bunch of coal plants that just aren't making any money, and obviously, as long as there's been finance, it's been hard to finance assets that don't make any money. But there's also the sort of the risk perspective, and the theory, at least to me, says there's plenty of capital that's not under the same scrutiny of Europeans, but certainly the anecdotes suggest that people are struggling. Can you tell, just to dig into that one? So how does a decision get made on ESG grounds then within, as you say, I suppose you're not doing it now in the sense that you're not doing project finance against coal assets specifically, but like rewind a couple of years, there's someone in the bank who has built his whole career around coal finance or something like that. His bonus is a function of, at least to an extent, how much he can lend against coal or gas assets. and he's dotted all the I's, crossed all the T's. Great deal, long-term contracted, all of those things for a coal asset. How does the decision not to lend against that presumably it's not his decision, unless he's super altruistic and he's like, I'll forgo my bonus to stop this coal plant getting finance. How does the decision get made within the bank? What's the check there?
So we clearly have ESG policies. Lending to coal projects would be prohibited under our ESG kind of policies. So that's the first and foremost. That's the first aspect. Then we also have an ESE team that would look at some of these considerations, and then we have a reputational risk committee or forum where approvers of transactions can refer a deal if they have concerns around anything related to kind of ESG, and I think that's something that I think we're increasingly finding with climate purpose, that even kind of beyond the policies we have in place, when transactions come in, particularly in the oil and gas space, that we have to sit back and give it some thought as to whether this is something that's aligned to our purpose and whether it's something the bank should be doing. So I think, increasingly, I think approvers will be referring those types of transactions to the rep risk forums for consideration.
Yeah, and I suppose if you are that guy, you probably want to have a few chats before you do too much work to say, is this gonna pass our hurdles before I do too much effort on financing an asset or something like that. Sort of having the policy means you don't actually get to that point of having to use the committee. In a dynamic game, it's sort of, okay, I know they're going to say no, so I'm not even going to bring it to them, is kind of probably how it resolves itself in a sense.
Yeah, no, exactly. But I guess that the policy means that certain transactions will be a non-starter, and that will be clear. But then when there's other transactions that come in that are in the grey area, then the banker will start to have some conversations with the relevant people early on to decide whether it's worth then having the discussion at a rep risk forum.
Mm-hmm. Interesting. And it is like, I've got a slightly broader question on that. They're not related to ESG or climate or any policies like that. It's related to just the relationship between, the banker and the credit team within a bank. And it's sort of, it's an interesting relationship. It's like one sort of narrow way of viewing it, at least from my perspective, is it's an adversarial system, right? And it's like there's someone in the bank who wants to get lots of money out the door, and that's the basis of his bonus, and the bank wants to lend. Bank policies, we want to lend against these assets, and the credit guy is there to say, look, that's great, but we need to set the bar at the right level and be prudent about these things. And adversarial systems are great. The whole legal system is largely based on an adversarial pursuit of truth. So there's in a sense there's all sorts of precedents for these great adversarial systems. But how does it work best, that relationship, do you think, between what I call banker and credit team in a bank? Where have you seen that work really well to do high value, impactful lending?
So I think that the challenge for the banker and the credit team are how to assess and analyze something which is new, a new sector, a new asset class. What risks are acceptable, how can we structure around them, and I think that's particularly relevant in the energy space at the moment, which is obviously kind of quite dynamic, and we expect to see new things come through. Financing a subsidized renewables transaction or a CFD backed transaction, everyone knows what the risks are and what the parameters are, so everyone can focus in quite quickly on the areas of concern, and risk. When something new is presented, then it feels very different because everyone needs to go back to basics. What are the risks? How do we structure around them? And both parties need to come with an open mind and work constructively. Even where we see transactions which are challenging and not easy, it's not really acceptable for us to say, we don't understand those risks, we haven't seen them before, we're not going to do it. we have to move with the market, and we have to look at new developments as they happen. So that's something that we have to do. And I guess if in terms of recent examples, obviously, as I mentioned before, unsubsidized renewables is something which we all felt was challenging, or certainly some of the transactions coming through were challenging, and the team had to work with credit colleagues to put in place the policies and the parameters and the methodology to approach that sector, and a lot of work went in across the teams to make that happen. I think we got to a great outcome in the end with respect to the methodology that we have. I suppose the other recent example is broadband fibre, where 3 years ago we'd never seen a broadband fibre deal before, and they started coming in quite quickly, and we had to kind of get up to speed and understand the risks and work out how to get comfortable, and now we have a very significant book in broadband fibre, and we all understand those risks much better. But the first one we saw was very challenging for us.
So I'd like to conclude the show by asking you about a few concepts in the energy transition, and I'd like to ask you if you think they're overrated or underrated. It's totally fine to give a one-word answer of overrated or underrated, but the idea is, or a sentence or whatever you like. But the idea is that it's easy to say something is good or bad. Where you make insight, where you make money in investment, is if you work out if something is underrated or overrated. So that's the spirit of the questions here. So let me start with the first concept here, which is policy risks impact on the cost of capital. We've touched on this before. We talked about Southern Europe and post credit crisis impacts. Do you think the impact of policy risk on the cost of capital is overrated or underrated by, relatively well-informed energy sector participants?
Well, to be controversial, I would kind of go in the middle and say it's probably rated about right.
Okay.
It clearly has an impact. Policy has to set the framework for private finance. Ultimately, kind of set up the business proposition, the business models that the private sector can finance. But I think I think we all understand that, and I think I think kind of, well, certainly in the UK, I think kind of policymakers understand the impact that policy has on ability to finance transactions. I mean, ultimately, it sets the framework and the risk framework which private finance has to operate within.
Mm-hmm. Yeah, it's one of those things where whenever policy change, I mean, I think most people would accept policy needs to change. Technology is changing, competition is changing, our understanding of the world around us is changing, whether that's kind of technology or whether it's economics. So the policies of 30 years ago would probably be inferior to the policies of today in many ways. But having said that, when policies do change, there will always be someone who's aggrieved by it and says this is creating too much risk. It's one of those things where you need to see it over a long period of time to watch these play out. Okay, the second concept is the role of private sector finance in driving the energy transition. Again, I suppose we've talked about this quite a bit. Do you think, and of course there are alternatives to private sector finance. There's, government can play a big role, and arguably we'd be nowhere without government's strong support for decarbonisation. Do you think the role of private sector finance in driving the energy transition is overrated or underrated?
It's overrated to the extent that where the business models are there, then the private finance will be available to finance those business models. We know at the moment there is significant amounts of capital available from institutions and from banks to finance renewables and transition. But for it to come to bear, then the business models need to be there, that the contractual arrangements need to be there, and there needs to be appropriate kind of allocation of risk for the providers of finance. But we need to get to that position where the business models are in place, and there is a role of public policy to get us to that position. I think the concept that transition will just happen organically and commercially, I think is overrated, because I don't think it can. I mean, I guess if you look at kind of EV charging, for instance, it feels like the rollout of EV charging has been slow. That's because it's generally happening on a commercial basis, and I think there's a question as to whether the pace of the rollout of EV charging is impacting the pace of uptake of EVs and the vehicles. So, is there more of a role for the public sector to put in place the business model and support the business model? Perhaps if you want to go faster.
Okay, the third concept, the role of markets in driving decarbonisation. So, and by that, what I mean by that is, we have markets for electricity, we've got markets for capacity, we've got markets for ancillary services, we've got, all sorts of markets. We've got retail price offers that reflect the value of electricity in the intraday market. There's a different variant of decarbonisation, one that we've used quite successfully in the past around feed-in tariffs and CFDs, which aren't markets. They're bilateral contracts with government, sometimes allocated on a competitive basis, I suppose. So do you think the role of markets in driving decarbonisation right now is overrated or underrated?
I would say it's underrated, and I think kind of markets have a very significant role to play in driving decarbonisation. I mean, I think what we're seeing now is financial institutions are highly focused on the carbon impact of assets in their portfolios. So whether it's banks setting targets for financed emissions, or institutions moving capital to green or sustainable investments, I think there's a real concern in institutions around the future value of their investments, or the credit worthiness of borrowers for companies in high carbon sectors, and those values and creditworthiness could be seriously impaired and quite quickly in scenarios where we transition quickly to a low carbon economy, in kind of Paris aligned, if you like, kind of 1.5 degree scenarios where things happen quickly. We could see some significant stranded assets and reductions in value. So I think banks and financial institutions are extremely focused on this point now, and I think ultimately that will drive lending and investment decisions, and I think it will have an impact on cost of capital.
Mm-hmm, mm-hmm. Excellent. Well, that's a natural time to finish, Bruce. From me, it was a real pleasure to hear your unique perspectives on this really vital area of the energy transition. So, Bruce Riley, thank you for taking the time to speak.
Thank you, John.
That was John Feddersen, co-founder and chief executive of Aurora Energy Research, speaking to Bruce Riley, managing director for infrastructure and project finance at NatWest. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.